Now let's take a closer look at what's been happening on the local share market. I spoke to Ken Howard at RBS Morgans. Well, the slide has resumed on the local market. I can think of lots of reasons why that might have happened. What do you put it down to?
I think the biggest reason remains Europe. What we saw overnight and what we've seen over the last week is that the US government bond rate has contracted to under 3%, and that's certainly a sign that global investors are feeling nervous. They're buying up the US government bonds and pushing down those yields. In Europe, what we're actually seeing is the government bond rates of places like Spain and Italy heading up towards 6%. In fact, for Spain, they are above 6%. So bond investors are clearly signalling to global credit markets and global investment markets that they're not happy with the pace of change, with the pace of decision-making that's happening in Europe to resolve the Greek debt crisis. And if bond markets continue to behave this way, it will be a source of contagion for global credit markets. So that's why the Australian market, I believe, is so skittish and so nervous at the moment, is we're just not getting the resolutions in Europe that we need.
Well, we had a miserable day for retail stocks after that David Jones profit downgrade. So take us through why the rest of the sector is so spooked.
Look, I think the lead came with the consumer confidence numbers the other day. The consumer here in Australia, I guess, is a bit of a barometer for global credit investors. Australian households are feeling cautious. The household savings rate remains at elevated levels and I guess is likely to persist at that level, maybe even for years, particularly if Europe and other places take a considerable period of time to sort out their problems. So a lack of consumer confidence, high household savings rates, that leads into a lack of retail spending. So the paradox of saving is that what you're saving is somebody else's income, and right now what they're saving is the income of the big retailers like David Jones, Harvey Norman, JB Hi-Fi, Myer, etc. Now, it would be nice to think that confidence returns and returns quickly, but that may not be the case. And I think that's why share market investors are cautious on that whole discretionary sector right now.
And bullion prices scaled record heights. How has that affected gold stocks?
Well, it should be a real positive for gold stocks. Obviously, for gold stocks here in Australia, the Australian dollar is another part of the equation. But really, it's just a sign of that flight to areas where people feel comfortable. So either they feel comfortable holding cash, holding US treasuries, holding gold, depending on your needs and your position. You know, that's what's going to be happening. So that'll be a positive for gold stocks, but obviously it'll be offset by the potential for a much higher Australian dollar if the woes in the US and Europe continue.
Okay, Ken Howard, thanks very much for your time.
Thank you.
To the other major movers on the local market, takeover target MacArthur Coal was up as it opened its books to Peabody Energy and ArcelorMittal. Aquila Resources was down more than 2%. The group has started legal action for damages from Vale, claiming it stopped the export of 4 shipments from the Isaac Plains mine. Iluka Resources was up 3.5% after the mineral sands miner flagged an increase in its full-year production target. And Qantas lost a further 2% as engineers threatened to take some unusual industrial action, with right-handed Qantas engineers using their left hand only to work on planes. Turning to currency markets, the dollar is up against the greenback, which sank on Ben Bernanke's talk of more money printing by the Federal Reserve. On to the commodity markets now, and in New York, oil is up a little. Gold hit a record high of $1,589 an ounce on sovereign debt concerns and the prospects of further stimulus by the Federal Reserve.